The rug pull is different every time. That's what makes it hard to see coming. Bitcoin has died before, or at least that's the joke. 80% drops, 90% drops. Long stretches where the price sits underwater for years, while people who bought at the top quietly stop mentioning it at parties. And every single time, it came back, sometimes higher than before. That history is the whole problem, because it teaches everyone who holds Bitcoin the same lesson. This is just what it does. You hold through it, you've held through worse. So when the price starts falling this time, almost nobody treats it as different. It looks like the last one. It looks like the one before that. Forums fill with the same lines that have worked, historically, as a kind of ritual reassurance. This is a shakeout, weak hands are leaving, the real holders are still here. Some people buy more on the way down, because buying the dip has been the correct move in every previous cycle. That behavior isn't stupidity. It's pattern matching on genuinely good data, until the pattern breaks. The pattern breaks slowly enough that almost no one can pinpoint the moment. There's no single afternoon where a headline announces, "This is the one that doesn't come back." Instead, the price keeps falling past the floors where it stopped last time. It falls through the level, where the loudest voices said institutional buyers would step in. It falls through the level where mining costs were supposed to create a floor, because in theory, miners won't sell below what it costs them to produce a coin. Each broken floor gets explained away individually. Only in retrospect, days or weeks in, does the pattern of broken floors become impossible to explain away collectively. By then, something else has already taken over the decline, and it no longer has anything to do with what anyone believes. That something is leverage. A large share of the money trading Bitcoin isn't spending cash to buy coins outright. It's borrowing against a position, betting that a smaller move up will be amplified into a bigger return. Exchanges that offer this kind of leverage trading protect themselves with automatic systems. If the price drops far enough that a trader's collateral no longer covers their debt, the position gets closed automatically, without asking permission. That forced closing is itself a sell order. A large enough wave of forced sell orders pushes the price down further, which triggers the next tier of positions, which forces more selling. This isn't a rumor spreading or a mood shifting. It's a mechanical chain reaction, and it runs the same way, whether the people caught in it still believe in Bitcoin or not. Belief stops being relevant. The machine doesn't check anyone's confidence before liquidating their account. This is what makes the crash different in kind, not just in size, from everything before it. In past crashes, the floor eventually held, because enough capital was waiting on the sidelines, ready to buy the discount, and that buying pressure absorbed the selling. This time, every rebound gets sold in two by people trying to get out before the next leg down. A few of the exchanges that offered the most aggressive leverage can't cover what they owe their own users because the collateral backing those loans is now worth a fraction of what it was when the loans were issued, and they freeze withdrawals. That freezing is its own kind of confirmation. The moment people can't get their money out is the moment even the most stubborn holders start to understand. This isn't behaving like any crash before it. While all of this plays out on trading screens, a much larger and slower machine is grinding through its own version of the same realization, several steps removed from any exchange. Bitcoin mining is not a metaphor. It's an industrial business. And like any industrial business, it runs on a simple comparison. Does the revenue from what you produce exceed the cost of producing it? A mining operation is a warehouse full of specialized computers, doing nothing but solving a mathematical puzzle over and over, competing against every other miner in the world for the reward of solving it first. That reward is paid in Bitcoin. The computers cost real money to buy and run, mostly in electricity, often under multi-year contracts negotiated specifically, because mining is such a large, predictable power customer. As long as the reward is worth more than the cost of winning it, mining is a profitable business, and companies borrow to expand it, sign longer power contracts, build bigger facilities. None of that math survives a reward worth zero. It doesn't matter how efficient the hardware is or how cheap the electricity. Multiplying any real cost by nothing always loses money. The instant the price is genuinely, permanently zero, mining stops being a business and becomes a way to burn electricity for a certificate no one will buy. Miners don't all shut down in the same second, because information and denial move at human speed, even when the math is instant. Some operators keep running for days, out of the same "this has to come back" instinct that gripped individual holders, eating losses because shutting down a facility and laying off a crew feels more final than waiting one more week. But the number doesn't change, and one by one, then in waves, the machines go quiet. Bitcoin's own rules respond to this automatically, in a way nothing on the exchange side does. The network adjusts how hard the underlying puzzle is roughly every 2 weeks, specifically to keep new blocks arriving at a steady pace, regardless of how many miners are participating. As miners drop offline, the difficulty adjusts downward, making it easier for the remaining machines to win rewards. Rewards still worth nothing, but the protocol doesn't know or care about price, only about keeping the network's clock ticking. That single fact matters more than it seems right now. The network is, mechanically, indifferent to the collapse happening around it. That comes back later. In the meantime, mining companies, many publicly traded, many carrying debt taken on to buy hardware during better years, watch their revenue go to zero, while costs, especially power contracts signed months or years in advance, don't disappear on the same schedule. Some can renegotiate or exit those contracts. Many can't, at least not immediately, which means for a stretch of time, they're paying real money for power to run machines producing something worthless. Because the alternative, breaking a contract, defaulting on debt, laying off a trained workforce, carries its own costs and its own timeline. Stock prices for these companies, which had tracked Bitcoin's price with almost comic precision for years, now do something new. They don't fall toward zero and find a floor set by the physical value of the facility. Some do. The buildings, the land, the power contracts might still be worth something, even if the core business isn't. Others simply become uninvestable, because a warehouse full of hardware, whose only function is now unprofitable computation, isn't worth much more than the copper and silicon inside it. That hardware is its own small, strange casualty. The specialized chips inside mining machines are built for exactly one task and nothing else. They can't pivot to some other job the way a general computer could. When mining stops being profitable, that hardware doesn't become slightly less valuable. It becomes close to worthless all at once. An enormous quantity of recently purchased, specialized equipment, most of it now suitable mainly for scrap. By the time the mining industry's collapse is fully visible, hash rate falling, difficulty adjusting to compensate, companies missing debt payments, workers let go from facilities that had, until recently, been expanding, the story has stopped being about an asset losing value on a screen. It's become a story about an industry, with employees and buildings and contracts and debt being switched off in real time, because the one thing it produced no longer has a buyer at any price. Which raises a harder question than who lost money speculating. It raises the question of who else built something real, something load-bearing, on top of an asset that has just gone permanently to zero. Some of those load-bearing structures were corporate balance sheets, built deliberately by executives who treated Bitcoin not as a speculative bet, but as a superior version of cash. The logic had a certain internal consistency while the price was rising. A company sitting on a large cash reserve earns very little holding that cash in a bank account. If you believe an asset will appreciate faster than inflation erodes your dollars, converting some of your treasury into that asset looks like a smart, if unconventional, corporate finance decision. And for years, for the companies that did it early, it worked spectacularly. It worked well enough that some didn't stop at converting cash they already had. They borrowed additional money, using their Bitcoin holdings as collateral, specifically to buy more Bitcoin, a bet that appreciation would outrun the interest on the loan. It's the same leverage mechanism that hit exchange traders, just wearing a suit and filed with regulators, instead of automated on a trading app. A permanent zero doesn't partially damage that structure. It removes the collateral entirely. A loan once backed by an asset worth many times its value is now backed by nothing, which triggers exactly the kind of covenant lenders write into agreements, specifically to protect themselves. Demand for repayment, seizure of remaining assets, or a restructuring negotiated from total weakness. A company whose core strategic asset has gone to zero and whose debt is still fully real doesn't have a Bitcoin problem anymore. It has a solvency problem. And solvency problems move through bankruptcy courts and boardrooms. on a timeline of weeks and months, rather than the minutes it took an exchange's liquidation engine to close out a trade. This is where two branches that started out looking separate turn out to be the same branch wearing different clothes. Some of the mining companies devastated by their revenue disappearing were, at the same time, treasury holders, using spare cash to buy Bitcoin as an investment, on top of running a business that produced it. For those companies, zero isn't one blow. It's two, landing simultaneously. The operating business that makes Bitcoin becomes worthless to run, and the balance sheet asset that stores Bitcoin becomes worthless to hold. There's no diversification benefit in owning two different exposures to the same underlying collapse. A company positioned that way doesn't have a bad quarter. It has an extinction event, not because anyone did anything unusually reckless, but because betting the same direction twice on the same underlying thing is just leverage wearing a second costume. Executives at less exposed companies spend the following months doing something quieter but just as consequential, writing the loss into their books, explaining it to shareholders, revising whatever public statements they'd made about Bitcoin as a strategic asset, statements that, in better years, had been proud announcements, and now become the kind of thing quietly scrubbed from investor materials rather than defended. None of this makes headlines the way an exchange freezing withdrawals does. It's slower, more procedural, and in its own way more permanent, the kind of write-down that shows up in a footnote for years. While corporate treasuries work through bankruptcy filings and quiet restructurings, a different kind of institution deals with a version of the same problem, at a scale that doesn't fit inside a courtroom. A small number of countries had, in the preceding years, made Bitcoin legal tender, meaning businesses were required or strongly encouraged to accept it as payment alongside their national currency, and the government itself held some portion of its reserves in it, as both an investment and a statement of intent. The stated logic combined genuine economic reasoning, attracting investment, giving unbanked citizens access to a global financial network, reducing dependence on remittance companies that charge steep fees on money sent home by workers abroad, with a fair amount of national branding, betting early on a technology, and hoping the association would pay off in prestige as much as returns. Legal tender status doesn't disappear the instant an asset's price does. It's written into law, and unwinding a law takes longer than unwinding a trading position. In the meantime, ordinary consequences ripple through daily life in a way that has nothing to do with speculation and everything to do with plumbing. Merchants who built point-of-sale systems around accepting Bitcoin now hold an asset that settles for nothing the moment a transaction clears. Government reserves, whatever portion had been converted, are marked down to zero on the national balance sheet. A real fiscal loss publicly attributable in a way a private investor's loss never has to be. The country's actual currency isn't directly threatened by any of this. Ordinary monetary policy still works the way it always has. But the government's credibility on the specific bet it made publicly, and by name, is a different matter, and that's a cost paid out over years of political cycles, not weeks of market panic. Reversing the legal tender law eventually becomes the boring, administrative, almost anticlimactic ending to what had been a genuinely bold experiment. A parliamentary vote, a transition period, businesses quietly reverting their systems, and international coverage that treats the reversal as far less newsworthy than the original announcement had been. There's one more category of Bitcoin's economic life that was never really about investment at all, and it turns out to be the most instructive part of the entire collapse, because it reveals what Bitcoin's price was actually protecting. Bitcoin had, for a long stretch of its existence, functioned as a preferred payment method for a specific kind of transaction. Ransomware operators demanding payment to unlock a victim's data, darknet marketplaces trading in things no legitimate payment processor would touch, and a general category of person or organization who needed to move value across borders without a bank noticing or caring. What made Bitcoin useful for this wasn't ideology. It was a specific, practical combination, a payment method not controlled by any single company or government, transactions that don't require identifying yourself the way a bank transfer does, and enough liquidity and general acceptance that the coins received were actually worth something once converted back into usable currency somewhere down the line. That last piece is the one zero destroys, and it's the only piece that mattered from a criminal economy standpoint. Nobody demanding a ransom payment cares about Bitcoin specifically. the way an ideological early adopter might. They care about getting paid in something they can convert into money they can spend without a paper trail leading back to them. The moment Bitcoin can't be converted into anything, it stops being useful for that purpose immediately. Faster, in fact, than almost any other consequence in this scenario, because criminal actors have the least patience for holding a depreciating asset out of loyalty. The demand for private, hard-to-trace value transfer doesn't go anywhere. It migrates within days to whatever the next most convenient substitute happens to be. Other cryptocurrencies that still hold value, privacy-focused alternatives built specifically to resist tracing, or older, lower-tech methods that predate Bitcoin entirely and never went away, just became less convenient by comparison. It's the cleanest illustration in the whole collapse of a principle that applies almost everywhere else, just less visibly. Bitcoin was never the actual thing anyone needed. It was one solution to underlying needs: private value transfer, a hedge against local currency instability, a way to move money past institutions that don't want it moved. And every one of those needs survives the death of this particular tool completely intact, which is, in the end, the distinction the entire collapse has been quietly building toward, whether or not anyone watching it happen thought about it in these terms. Bitcoin the investment and Bitcoin the network turn out to be two different things. Almost nobody had to consciously separate while the price was real, because the two moved together so consistently that the difference didn't matter. The investment is gone completely. The exchanges, the leverage, the treasury companies, the legal tender experiments, the trillion-dollar structure of belief and capital built on top of a number going up. None of that comes back, because none of it was ever really about the protocol. It was about the price, and the price is now permanently, mechanically zero. But the network itself, the actual rules, the actual blockchain, the actual software running on actual computers around the world, never needed the price to function. It needed only enough people willing to run it. And it turns out a small number of people always were going to keep doing that regardless of profitability. True believers running nodes on principle, hobbyists with cheap electricity and old hardware who never cared about the economics, researchers and archivists who want the historical ledger preserved intact, and a handful of miners who keep a machine or two running, less as a business than as a kind of vigil. The difficulty adjustment that spent the crash grinding downward to compensate for departing miners eventually finds a new, much lower floor and settles there. Blocks keep arriving, a little slower and a little less contested than before, verified by a fraction of the machines that once competed for a reward, now worth nothing to anyone who'd sell it. Nobody is getting rich off this anymore. Nobody's mortgage depends on it. Nobody's national reserves are measured in it. No ransomware operator wants to be paid in it. The trillion-dollar financial world that grew up around Bitcoin's price is simply gone, the way a company's stock goes to zero, and the company itself, whatever's left of it, becomes a footnote. What's left is smaller, stranger, and in its own way more honest than what came before. A ledger nobody can profit from, kept running by people who never needed it to be worth anything in the first place, quietly proving a fact the preceding boom had made almost impossible to see clearly, that the price and the protocol were never actually the same thing, and only one of them ever depended on the other.